my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is a weekly technical analysis of New York and London sugar markets. I'll start with ice or raw sugar in New York. Now the core of the bullish support here for the last few months has been the lower time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1778. I've highlighted the whole pitchfork in blue so you can visualize the tines more clearly, as they will actually become more important with regard to last week's action. This lower tine caused some very prominent rises in the market, most recently in late October. That sort of market gap higher and push up over all the moving averages. The significant February 2021 high at 1894. The congestion at 1964, and most recently the middle tine of the same big bullish shift pitchfork, currently at 2228. I'd also previously highlighted the August to November bull channel in red to help visualize this, as prices punched up and closed over the upper bull channel line, currently 1884. I'd also detailed earlier some potential targets topside for this pattern. Thus we had an initial target X in the 1990 area and a secondary harder to reach target X1 in the 2020 area. In the process of rising up through and out of the bull channel, the market made a breakaway gap at the very start of November and a midway gap 2 weeks ago, and a third exhaustion gap which has since been filled in last week. The market didn't quite reach the 2080s to make this third gap, but it did show that the analysis of such gaps works. Back into the bull channel, I had previously detailed potential targets for the break up and out of the bull channel. So 2 weeks ago the market rose up to the primary target X in the 1990 area. However, I was wary as to whether the market would make it as far as the secondary harder to reach target X1 in the 2020 area, because of a simple reason. I detailed this last week thus, and I quote, "So it's time to start looking at potential resistances topside. The one that stands out is the middle time, currently 2003, of the previously mentioned December 2020 to April 2021 bullish shift pitchfork. Now this is resistance, but it is flexible, in that once breached it can turn into support. Looking higher, I think you will have to look at the May high at 2024 and the April congestion at 2047, both of which sit within the January to February 2017 congestion between 2010 and 21 even." End of quote. What was interesting this past week was how a number of those previously highlighted resistances all came into play. The middle time did come into play, but it was, as I stated, flexible and acted more as a gentle braking action to the rise rather than an end to itself. This allowed target X1 to ultimately be reached, and then for the market to peak and halt at the April base congestion at 2047, within the larger 2010 to 2010 congestion. We have since seen the market dip to the congestion at 1964, only to close last Friday just over the middle tine again, and also fill in that exhaustion gap. This would indicate that perhaps there is more in the tank for a potential move upside, but I am wary, as this market has done a lot and now maybe might need a bit of consolidation or further pattern building. See, I'm very interested to see where the consolidation made last week, where it will take us. I'm keeping an eye on that now. Ice Europe white sugar in London. Changeovers produce some strange events here. Since mid-September, this market has been dominated by the one action, the changeover gap that happened back then. I'm going to say a lot of things about what happened beforehand, but that changeover gap here on a continuous daily chart is really big. The action stretches from roughly the September 2016 high at 619 down to the 50% Fibonacci line of the July 21 today action at 522.80. And a congestion seen in early 2017 at 517.80. The actual gap is from 541 to 603.60, and there's been a number of attempts, initially tepid in September, but more active in mid-October to try and fill it. And the latest attempt higher this past week made some great strides in filling in that gap, but it ran short of it because of another changeover that ended up with an island top either side of the weekend before last. We've since then seen prices fall away on a daily continuous chart below the long moving average, currently at 542.90, and below the neckline of the August to December complex head and shoulders top, currently at 563.70. This neckline looks like a possible indicator of the angle of attack of the market, so I'm minded to regard it as important. Yet we've also found that prices didn't like it down there at the end of last week, with last Friday's action being a combination of immediate countering bullish engulfing pattern and bullish opening white Mariposa, though today that bullish action seems to have been countered with what looks like a, well, I'm not quite sure whether it will be a bearish army or not, but we'll see. It has to be honest, it's left the whole situation a bit up in the air. Last week I was minded to look at the whole space since the changeover as possibly a type of double bottom, and I laid out some possible targets for such a pattern, with the primary target X in the 606.30 area and the secondary harder to reach target X1 in the 621.20 area. Today I'm minded to regard those potential targets as a little premature, and so I will retire them after this commentary. It's saying all that, the last three groups of lows in late October, early November and then last week have all been higher, something that is usually associated with bullish markets. As well, this no doubt looks like a market that is reacting to the downside. I am not as wholly convinced that the top side is off limits. I need to see more market action before looking to see what is going on. I'm a little like the short, medium and medium moving averages here, currently at 547.20 and 548.20 respectively. Just a little bit mixed up with contrary thoughts. Sugar white premium spread. I've previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old Andrews pitchfork from 2019 to 2021 highlighted in blue. The market currently between the lower time below, currently 80.25, and the middle time above, currently 154.25. Though it had been breached, it has since been mended such that this pitchfork is still showing the bullish angled attack. We also have an ascending expanding wedge pattern highlighted in red trend lines that has been formed since mid-April, currently 143.5 to right off the top of my weekly chart. To me, it has and is still not the best looking such pattern that I've ever seen, but it is also still there, and it comes with all the possibilities such a pattern can evoke. A sub point has been the monthly key reversal down we saw in September. Despite what has happened since, which seems to justify this selection, please still take this monthly key reversal with a huge pinch of salt, as the earlier monthly key reversals down we saw in July did not work out so well. Nevertheless, it seems to be genuine. The most recent activity has obviously been last week's counter to the counter weekly key reversal down, which offsets by a country mile the previous week's combination of previous week's countering bullish engulfing pattern, and that offsets the previous week's combination and supports the earlier bearish engulfing pattern. The top for the last 3 weeks action has been the neckline of the big June 2021 to May 2022 reverse head and shoulders pattern, which I've highlighted in bright green, currently at 143 even. Interestingly, last week justified part of my commentary I'd made 2 weeks prior that was not immediately picked up at the time, and that was, and I quote, "Below the long moving average, you have really nothing much until the late April, early May congestion based around the lesser Fibonacci lines at 104.5 and 107.5. The core of this congestion is the 102 even to 107 even zone." End of quote. I continued, and I quote again, "So with all these actions and points, it's time to look at possible targets below for the break below the ascending expanding wedge pattern. Thus, potential target X on the downside would be in the 102 zone, just below the late April, early May congestion." 2 weeks ago, this looked like looked a little distant right now, right then, but not so now. Last week, prices dropped down to reach target X at 102 congestion and ended up quite a way below it actually, as they are now. However, I'm mindful that we're approaching the lower time, currently 80.25 of the big 2019 to 2021 bullish Andrews pitchfork, as well as the neckline of the February to September 2020 head and shoulders top, currently at 75.75, below which I've highlighted on my daily chart in pink. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. The only other thing I've actually added, on second thoughts, actually some reflection, is I've added potential target X1, a much harder to reach target for the expanding wedge pattern. That's down at 46 3/4. Anyway, thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.